everyone. Welcome to the wealthmanagement.com Fast Chat. Today, I'm speaking with Peter Higgins, the head of fixed income and a senior portfolio manager at Shelton Capital Management. Peter, thanks for joining us.
Thanks for having me, David. Appreciate being here.
So we want to talk a little bit about the fixed income markets and what's going on today. What do you see? What's driving the fixed income bond prices today?
Same thing that's been driving it really throughout the course of 2022, inflation. Inflation proved not to be transient. It is very real. And today's CPI number is quite timely for this conversation because it came in a little bit higher than expectations, ever so slightly hot, but the trend line is going in the right direction on a year-over-year basis. That being said, it still is persistently too high for the Fed's comfort level. And we've got this period where rates theoretically should remain higher for longer. Of course, that has been thrown, a wrench has been thrown into the mix with the two failed banks last week.
Yes, for sure. We should note that we're recording this on March 14th. I think a few days before the Fed meeting where they are going to decide their next rate hike. Last year, terrible year for fixed income. Is the rising rates now kind of unlocking income from fixed income now? Are we finally going to get income from fixed income?
Yeah, absolutely. I mean, you're right in the fact that last year was horrendous. Be long in this market was a painful process. There's been a lot of press written about the traditional 60-40 splits where both sides of that equation failed. But the only silver lining that came out of those negative returns last year is a much better entry point to fixed income this year. And just to put that into perspective, a lot of market participants use the Bloomberg Ag as the benchmark index for broader fixed income. That yield last year was 1.8% at the end of 2021. We're up to 4.45. The list goes on. You're north of 9% in high yield corporate bonds, and your taxable equivalent yields on munis are nearly 6%. So it's really the first time in the last few decades where investors have had what I would call a more prolonged opportunity to capture yield in the asset class. I stress the word prolonged because inflation is sticking around. The rates are remaining higher and more elevated, which means the power of the coupon is very strong for investors seeking total returns, from that interest income component of the equation.
Sure. So given that, why has volatility continued in the bond market?
I think it all, January was a blip. The markets rallied. Things felt very good. February volatility returned. Basically, the catalyst for that action was the non-farm payrolls number for the month of January, which came out in early February, much higher than all expectations, almost too good to be true. So the markets, I thought, to that point, had been fighting the Fed. And there's that age-old adage where you are not meant to be fighting the Fed. 2 days before the non-farm payroll number was the Fed made a statement, the FOMC statement, and subsequent press release. And I think Powell basically wasn't necessarily waving the flag, but he did say, hey, I'm just done fighting the markets, but let's just let the data speak. And the data on that Friday came out with non-farm payrolls swinging. Ever since then, market has started to reprice, the terminal rate higher. That has also been aided by not just Powell, but Fed governors speaking more hawkishly about higher rates for longer. And, fast forward to last Tuesday when Powell was in front of the Senate, that was another pivotal period where, 50 basis point hike for March was back on the table. I think as later in last week, there was an over 70% chance that the market was pricing in a 50 basis point hike. And then, of course, the Silicon Valley Bank episode occurred. And this poses a very big dilemma, frankly, for the Fed. Their job is this. Well, they have a few jobs. They wear a few hats. One is to maintain employment. The other is to maintain inflation, and the other is to maintain financial stability. Well, the dilemma now that we now have is what's going on with the banks here in the United States, especially those regional banks. Is there a contagion? Is there systemic risk in the sector? To the government's credit, the Treasury, the Fed, FDIC came out with a very well thought out plan over the weekend to contain this risk. If you look at the screens today, granted they are moving fairly quickly, but it does feel like the banking sector is much better positioned than it was yesterday. So if you believe that risk is contained, then the Fed can start looking at inflation again. And was today's CPI number hot enough to warrant a 50 basis point move in light of the broader banking sector turmoil? I don't believe it is, but I do think it still warrants a 25 basis point move. And then my belief is that the Fed will continue to focus on that data and let the data do the talking. But of course, as we know, the data is always backwards looking, and they're supposed to have their crystal ball, but we need to really understand the ramifications for rising rates, and if there are any other skeletons lurking out there in closets like we witness with the banking sector right now.
Yeah, for sure. We don't know how big of a wrench that was thrown into the works yet. We'll have to see how that plays out in the next few days, I guess. But given the volatility, rise in rates, fastest rise in interest rates, I think in history or certain recent memory, anyway, has that led you to change your strategy at all at Shelton Capital Management? What are the implications for your strategy?
We did go into the year thinking rates would remain higher for longer. And at Shelton, we have a tactical credit fund that really focuses on municipal bonds and corporate bonds. And when rates remain higher for longer, municipal bonds don't get the total return component of their income from falling rates because they are fairly correlated with U.S. Treasuries. So it's an income game. On the corporate side, however, there's this kind of tug of war going on, I think, with all different types of investors. Some investors want to focus on all-in yield. Other investors want to focus on spread. And the all-in yield, as we touched on earlier, is exceptionally high from a historical standpoint and will continue to bounce along at these attractive levels. Spreads are a little bit different, where theoretically, the longer rates remain higher, the more damage that will occur to corporate profitability. If nothing else, your interest expense is going higher. But when rates are remaining higher, it's because there's inflation. So can these companies continue to pass along price increases with the products that they sell to drive revenues, to enhance those profit margins? Or are those margins going to get hit by higher interest costs or even higher input costs? Price of raw materials are up. So, our thesis going into the year was that the lower rated, lower quality corporates, we wanted to avoid, either we were headed towards a recession or at least an earnings recession. And those credit spreads start to matter. And when we came into the year, that wasn't really priced appropriately for the macroeconomic backdrop. So we've stayed consistent in that straddling investment grade / high yield rating category with the benefit of our muni portfolio, which is an up in quality portfolio. But even on the corporate side, we've been mainly triple Bs and double Bs with very selected single B names. I've got to admit that felt off in January, but we feel pretty comfortable with positioning right now.
Yeah, you said that the credit mispriced earlier in the year. Is credit appropriately priced now, given the pending economy?
It's a good question. So again, some of this goes back to the investor base and what they're focusing on. There's a research piece done by JP Morgan that I'll quote because I think it's very relevant. When yields on high yield bonds are between 9 and 10%, the next 12 months returns are about 8.4%. That's what history tells us. But when spreads on high yield bonds are between 500 and 600 basis points like they are today, the next 12 months return is only 5%. So what's the difference here? Well, the difference here is spread. Corporate spread, bond spreads are meant to accommodate the investor for liquidity risk, default risk, which it goes hand in hand with micro fundamental risk. And in high yields and investment grade corporate spreads today, they're not pricing in recession risk. In fact, the spread on high yield bonds is 543. In a recession, that is 971 basis points. In non-recession, that average has been about 520. So at least we're wider now, thanks to this recent move, than we were, going into the year. Same thing can be said with IG. Investment grade corporate bonds are at 155 today. Their non-recessionary average is 120 basis points, but they're in recession, they can go as wide as 250. So we're not exactly pricing in recessionary risk. Do we get a recession? Most likely. And again, if not, it's going to be an earnings recession, which should still have the same impact for corporate bond spreads. They should be wider, especially as you go down the credit curve into CCC land, which perversely have still outperformed on a year-to-date basis, mainly to a big rally in January, which now seems like a very long time ago.
Yeah, so far this year anyway. More defaults probably coming in that class. So for advisors, financial advisors who are making recommendations to clients about fixed income products for the income part, how is Shelton recommending where to look?
Yeah, good question. For the income part, especially if you're a higher net worth individual who can benefit from the tax exempt status of municipal bonds, I think that is a very attractive place to be. When you have taxable equivalent yields at 6%, nearly 6%, compared to investment grade corporate bonds at roughly 5.5%, that is very attractive. And a lot of times what we see from financial advisors is a strategy that I actually think makes sense in this environment, where they institute a laddered strategy. They have their clients buy a 1 year, 2 year, 5 year, 10-year type maturities, so that they're locking in that kind of income today and are guaranteed to get that in the future. Obviously, there are no guarantees in financial markets, but what I would say is that the municipal bond market as a whole has an exceptionally low default rate. Investment grade has a low default rate, so you can pick up selectively a bit more yield, especially if you go down to the triple Bs. We are starting to get inquiry from clients about a corporate bond SMAs similarly structured to those munis, but it does have a touch more default risk, especially when there's fraud. Just the other day, Silicon Valley used to be traded off of the investment banks, investment grade trading desks, and now it's down there to distressed desks. Very rare that it skips over the high yield trading desks.
It's crazy. And does the strategy with municipal bonds for income hold true for the future? If we look at a more prolonged time period, advisors looking for income for their clients in a longer period, looking over the horizon.
So muni bonds trade very technically. It has a lot to do with their investor base, which roughly is half individual ownership. So there is somewhat of a herd mentality. When rates are rallying and going lower and the returns on municipal bonds tend to be positive, the investor base does pile on and come in, arguably a little too late, but they'll still catch some total return there. I think in this kind of setup with the macroeconomic backdrop, you can capture that attractive coupon for as far as inflation remains high. So there's this finite time. I do think it's more prolonged than we've witnessed in the last couple of decades, where you can capture that yield. But when the tide turns, and if we hit a recession, then government bond rates are going to rally, and munis are quite sensitive to them and highly correlated, so they will rally to a large extent as well. So it exists today. Is this recession coming in 2023 or 2004? I'm not sure. My hunch is that the Silicon Valley Bank episode has probably brought forward a bit of that recessionary risk. If nothing else, banks are not going to lend as aggressively as they did a couple weeks ago.
For sure. Yeah. And, the takeaway here, fixed income markets in general is a place where active management really earns its stripes, right? I mean, this is not a place to buy the ag, right? Prudent selection of issues is the important thing to keep in mind.
I would agree with that, David. The bottom line is we've had a few decades of rate rallies, government bond yields going lower and lower and lower. And it may, in hindsight, have paid to be in passive investment vehicles. While the future is much less certain, with uncertainty comes volatility. And that's where active managers should really be able to cut their teeth and earn their stripes. Volatility presents us the opportunity for total returns. What that means is, yes, you're getting an attractive interest income, but there's the other part to that total return equation is capital price appreciation. And when you've got, corporate bonds, even investment grade bonds trading south of 90 cents on the dollar, high yield trading, in the 80s and lower, there is a significant portion of that total return that's going to be captured from idiosyncratic risk and good old fashioned stock picking, or as we call it in fixed income, credit selection.
Fantastic. Well, Peter Higgins, this has been great. Peter Higgins, head of fixed income strategies at Shelton Capital Management. Thanks very much for the Fast Chat.
Thanks for having me. Appreciate it.